Swing trading in Forex. Beginner's Guide to Short-Term Trades. Swing trading is a popular trading strategy in the Forex market that aims to capture short-term price movements within an overall trend. It involves holding positions for a few days to weeks, taking advantage of price swings and retracements. Here's a beginner's guide to swing trading in Forex. Understanding swing trading. Swing trading focuses on identifying and trading within the intermediate price swings of a currency pair. Unlike day trading, which involves entering and exiting positions within a single trading day, swing trading allows for more time to analyze the market and capture larger price moves. Identify trends. Before engaging in swing trading, it's important to identify the overall trend of the currency pair. This can be done by analyzing price charts using technical analysis tools, such as trend lines, moving averages, or Ichimoku cloud. Swing traders generally aim to trade in the direction of the prevailing trend to increase the probability of successful trades. Use technical indicators. Technical indicators play a significant role in swing trading. They help traders identify potential entry and exit points and provide confirmation of price movements. Commonly used indicators include moving averages, MACD, RSI, and stochastic oscillator. These indicators can help identify overbought and oversold conditions, trend reversals, and price momentum. Set entry and exit points. Swing traders look for specific entry and exit points based on technical analysis. Entry points are typically identified near support levels in an uptrend or resistance levels in a downtrend. Traders may wait for price retracements or pullbacks before entering a trade. Exit points are often determined by setting profit targets or using trailing stops to protect profits as the trade moves in their favor. Risk management. Effective risk management is crucial in swing trading. Traders should determine their maximum risk per trade, usually as a percentage of their trading capital, and set stop-loss orders accordingly. Stop-loss orders help limit potential losses if the trade moves against expectations. Additionally, position sizing should be carefully calculated to ensure that the potential reward justifies the risk taken. Patience and discipline. Swing trading requires patience and discipline. Traders should wait for their trading setups to align with their strategy and avoid impulsive trading. It's important to stick to predetermined rules and avoid emotional decision-making. A trading journal can be helpful for keeping track of trades, analyzing mistakes, and refining strategies over time. Combine with fundamental analysis. While swing trading primarily focuses on technical analysis, it's important to consider fundamental factors that may impact the currency pair. Stay updated with economic news, central bank announcements, and geopolitical events that can influence the Forex market. Fundamental analysis can help identify potential catalysts for price movements and provide additional insights into trading decisions. Practice and gain experience. Swing trading, like any trading strategy, requires practice and experience to become proficient. Beginners are encouraged to start with demo accounts to familiarize themselves with the strategy and refine their skills. As experience grows, traders can gradually transition to live trading with proper risk management in place. Remember, swing trading is not without risks, and no strategy guarantees profits. It's important to thoroughly understand the strategy, conduct thorough analysis, and continuously learn and adapt to changing market conditions. Building a solid foundation of knowledge and experience is key to successful swing trading in the Forex market.